let's talk about the market this week. 3 weeks in a row, Steve, of nice gains for the broad market. 8 days in a row for the Dow.
You know, I always say this. I guess there's a station we always say it's the most unloved rally that I remember in recent history. Everyone got so lopsided in August. The positioning was so ultra negative that this had to happen. But when was it going to happen? Now over 3,000, everyone's still betting against it, which means it goes higher.
So you look, Tim, at what's happened since August, which was a pretty dark, dour month, often followed in September, which I think historically is the least
the worst,
good,
not a great month.
The least good month. But there's better news on trade, or at least the voices of better news on trade. Some of the macroeconomic data are better, and it's clear that central banks around the globe are being supportive.
Welcome, Tyler. And
good to be here.
Through a scary Friday the 13th. But that's exactly right. I think the macro has been supportive, and it's also highlighted. If you think about September, it's almost the mirror opposite of August. Look at the 10-year Treasury bond, 45 basis point recovery off the lows of effectively the 60 basis point rally. The other thing I would add is central banks are more confident. That is I know we don't really trust central banks, and I know they haven't been a source of credibility. But the fact of the matter is central banks around the world, not just people within our Fed showing at least some dissension, but the efficacy of lower rates as an option. That's basically good for risk assets, Tyler. That's good for reflation assets. And that's obviously good for sentiment about what they're seeing into the global economy that maybe the market was overly bearish about.
Jeff, I know you're going to talk a little bit about rates in just a minute. I don't want to steal your thunder there, but pick up on what Tim just talked about. The move in the 10-year bond this week and over the past few days is really quite something. 40 basis points about.
Yeah, it's been a big move, and the question is, are higher rates bad for stocks? And I think for right now, investors are at least getting a little bit of confidence that higher rates actually mean there isn't something more dour going on in the economy. I think that's really what's going on. And last year, the sentiment of the Fed is a little bit different, right? The Fed was tightening. People were worried about it spiking rates. So I don't think people are worried about rates going dramatically higher. But I think in terms of how you want to position here going forward, I think it depends how tactical you want to be. I think if we're sitting here 12 months from now, leadership probably reverts back to the growth, the defensive trade. I think economic growth probably remains sort of on trend, just below. The curve probably stays kind of flat. And I'm not sure you can count on political volatility completely going away. But to Steve's point, I think tactically, maybe over the next month or so, everything was so far to the one side that I think you're still seeing that mean reversion come back. AAII, bullish to bearish spread, it was negative 26%. It's now back to positive 2%, but the average is 8%. So even near all-time highs, you're still below that. So I think you have some room here over the next couple of weeks.
Dan, is this a rally you can believe in?
Well, listen, you know, we talk about it a lot on the desk. I mean, when the S&P has made new highs, it's been tough to buy the breakout. If you look at, dating back to January of 2018, every new high has been just incremental. It's been 1 or 2% above the past one. And I think, segueing a little bit to some of those stocks you're saying that are having a bad month, you mentioned Chipotle. I want to throw in McDonald's. McDonald's looked like it was spending most of August ready to break out above 220. I know, but, and I'm focused on McDonald's because obviously it's a Dow component, and they do as much sales in a quarter as Chipotle does in a year. And to me, this is obviously, I think, an important stock. And now it just dropped, 6-7%, kind of in a straight line. Those are the sorts of names, if you're thinking about tactically, right? Like when we make new highs, we've sold off a bunch over the last 18 months or so. That's what you want to keep an eye on to see if those sorts of names get overdone a little bit, because you have opportunities to buy good names, is what I'm saying.
Chipotle, though, is up 82% year to date. So I wonder if that was in the growth basket where you saw this rotation for out of growth into value. And even McDonald's, that's only up 18% year to date, that was seen as a growthy name, too. So you wonder if there's a little bit of granularity going on in this rotation.
Yeah. But Dan, no one was applauding when McDonald's and Chipotle and Starbucks were leading the S&P higher. In fact, everyone was saying this makes no sense. This is a sign of weakness. We aren't getting the breadth. But in fact, we've had enormous breadth over the last few weeks. We've actually had banks that have really, basically started to break out. You've had transports, you've had retail, you've had essentially the things that people wanted to see. So I think the question is, what do you do with these stocks?
I just want to make one point about that, though, that, each incremental spot, when we get to 2,900, that was a new high last year. Then we got to 3,000, that was a new high this year. It hasn't been a great time to buy stocks because we've had different rotations every single time. And we've had some of the mega cap names that used to drive a lot of the performance underperform, right? So there's been a lot of churn over the last year and a half or so. So there's no convincing evidence to believe that this time is going to be different, that it's going to be, especially as the rates are starting starting to go back up. That's a narrative I think is really important, because when people didn't believe that rates could go lower last year, the 10-year Treasury was above 3%, right? So we bottomed out at 1.45 last month, and now all of a sudden rising rates is bullish. And we're going to get some evidence next week, because whatever the Fed says, rates are going to move one way or another, and then we're going to have a sense of what investors really want.
But why would rates be going higher? Rates would be going higher.
Because they overshot to the downside. It's pretty simple.
Okay.
In a very short period of time.
The downside, which said we were going straight into recession. Remember, the first
There's
quarter
less worry about that now than there was 3 weeks ago.
But guys, hold on. You saw what the ECB did this week? And you saw what the president was saying all week about our central bank. Do you think that just because the 10-year has rallied 45 bips this week, that means that rates here aren't going lower? That's the most ludicrous statement I think anybody could make right now. I mean,
in the ECB, I do not trust. But when I look at the fact that fiscal policy is now being sought of as an alternative to monetary policy, which central bankers are saying has no efficacy. That's bullish. The biggest economy in the world, the biggest services component of its economy, reports a lot of strength. People were saying the U.S. was going out of business. The 10-year going down to 142 on the 10-year was not a function of the U.S. economy. It was a function of the ECB.
People weren't saying the U.S. was going out of business. Rates were saying that. Rates were saying that. I mean, so it's not like people, and we know how much bigger the Treasury market is to the equity market.
Been very pessimistic, and that in fact the positioning. Jeff talks about the AAII. If you just look at hedge fund net long positioning, and Marco Kolanovich brought this up also from JP Morgan's desk. It's only gotten to neutral, not overweight. So
there's been a lot of reasons to bet against it, and You've been right that everyone has been ultra negative, and I think that's what's fostering this upside potential. And when you get these light liquidity days or these big blast off days, once you have to really get off your fence. When you decide I can't buy it, you make a new high in the S&P. You're forced to cover your shorts.
So
there's only so long.
Finish your thought. I'm sorry.
There's only so long that you could sit it out and say, I'm not going to cover my retail shorts. I'm not going to cover my Macy's. I'm not going to cover everything that hasn't performed. I'm not going to cover my chemical names. I'm not going to cover my industrials or all these trade names that are trade responsive. So you have to sort of get in the market and say, you know what? Let me hold my nose. I'll cover 50%, see where we land after the Fed and after that news and all the dust settles.
Before we move on, I want to tie off our conversation about our 4 unlucky stocks that we highlighted at the top there. Amgen down 6%, Starbucks 5%, CMG, which is Chipotle, 4%, Ulta down 3% for the month so far. Is there something that ties this core 4 together, or are there declines particular to each individual company?
I mean, I think it's a little bit of both. If you look at companies like Starbucks and Chipotle, like Steve mentioned, they are way up. So maybe a 5 to 6% pullback isn't the only reason to dive right in, but fundamentals still look pretty good. I think Ulta is maybe a little bit of a different story. They have the large percentage of their revenues in makeup. It's a slowing part of their business. So I think there's a little bit of a different story there, and it's been absolutely crushed. I mean, knife through the 200-day moving average. So maybe do a little bit
that
of
overreacted though. So I think
So
to the point we have 2 that have performed, that have been the outperformers. We have 2 that haven't been the performers. And when you look at Amgen has fundamental reasons why the stock hasn't performed. So I would continue to stay away from Amgen. I actually bought Ulta today because it stopped right around where that December low was, and it's bouncing from there. And I think it's still good for a 10%
buy ratings are. I mean, even though price targets are coming down, they're still all above 300 and then some. So I'm not an expert in the company, but at least do a little work on it because I think it probably is overdone.
And let the record show that the 4 guys on this desk have a lot of revenue invested in makeup right now.
Well, I was actually going to say, Tyler,
right now, baby.
For as long as Fast Money does business, Ulta's going to have a pretty good demand source because let's just say
I didn't even have a goatee 5 minutes ago.
This
is all airbrush right now.